Hello, it's Massimiliano Magrini. I'm a founder and managing partner at United Ventures. So if we look back, basically, I think 10 years ago, basically, the European venture capital reshaped itself. There was another beginning. And basically, in 10 years, we did 10x in terms of growth. So there have been established players who grow big times in terms of fundraising, and there are new entrants in the market. So I think now the question of the value and the sense of venture investing is much more broad understood by many investors, and which is a good thing. It's never easy to fundraise, but it's different. Back then, there were very few investors strategically used to understand the underlying logic of venture capital. Now there are more and more entrants within the industry, but I think that the dynamics are pretty similar. So everybody starts raising, telling their story to individual or family offices or private investors, and eventually they evolve into fundraising to institutional LPs. And this is pretty much the story that nowadays. You start with an institutional, you end up with institutional, if you have the metrics to be appealing to them. Venture capital, you can look it from when you start to when you finish. So when you start, you have to rely on your track record, personal track record, on the track record of the team, of the thing you have done before starting a venture capital fund. So telling you the story and engage with those investors who are willing to invest based on that. At the end of the spectrum, meaning at the end of the fund, you should be having solid metrics to appeal to institutional investors. So for the following fund, then you have to have solid metrics in order to appeal to institutional investor. And this game of starting with telling the story and then come back with established numbers to appeal to institutional is exactly what characterizes the VCs. I think we are a European venture capital based in Milan that basically invests in people and not in markets. So I think this idea of countries is kind of old-fashioned. So we invest in people, and most of those people, they don't care. They are located in countries, but they invest in companies that become global. And so I think that the characteristics of Europe are pretty consistent across the board. And you start by capitalizing the early stage phase first, and then you add on the latest spurs afterwards. What we have to say that right now is the fully capitalized ecosystem is only the US. And so Europe has still to catch up with the US in order to have a full capitalized ecosystem. But we are getting there. There has been great step being made over the last 10 years. So the way I define ourselves, we are generalists with prepared mind, meaning that we have thesis, but we don't want to restrain us with a very specific thesis for a reason. It's very easy to tell LPs that you are totally focused vertically, but in reality, if we were here 15 years ago with a fund vertically focused on AI, we wouldn't invest in NVIDIA, for instance. So we have a thesis, we have ideas, we know how technology evolves over time, but we want to give the founders some serendipity and bandwidth in order for them to decide where to invest and us to follow along with them. It's the same story. You start with a family office individual investor, and then you evolve to institutional. If you add one more country to start fundraising with, once again, you start from individuals and family office, and over time you get to institutional. Until you have those solid metrics that you can appeal to anybody because numbers speaks for themselves. You have the DPI, the TVPI, and then it's a total different conversation. It's not about telling the story. It's part of that, but you have solid metrics that can appeal to those very sophisticated LPs. So I think the most important part for them is to understand the team, how the team works, because in reality, the only way to manage risk management at the venture capital level is to have a process in place in which team works seamlessly within a culture that stabilizes the core values of the investing strategy. And this is where the most sophisticated investors really care about. So how do you work? How do you make decisions? How you do due diligence? What kind of level of support you give to portfolio company? If you have a succession plan for the new managers. And that's what I think differentiate funds and partnership who are there for the long run instead of funds that are there for maybe launching one fund and maybe two, but they're going to be stopping there. To build a legacy, you need to have all those components being put together. Family office is totally different. On the family office, it's the other way around. You need to tell the story. You need to tell what kind of investment you made. There must be some sort of chemistry happening between the GP and the LPs. And which is good. I mean, because they can invest outside of the strict framework of judgment which characterize the institutional LPs, and it's very good. But it differentiates case by case. It's like the founder pitching a GP, the GP pitching an LP. It's the same kind of relationship. I mean, in this context, I think you need to be there. I mean, processes and reporting is very important, but ultimately it's a question of the impact that your investment are having into the overall society. And we are more interested on the second one other than the first one. That doesn't mean that we don't do the first one. We do the first one and we're very conscious in doing the first one, but we are even more conscious in making investment that can have a positive impact on the society.